Hi everyone and welcome. It's Steve Johnson here, Chief Investment Officer at Forager Funds, and today we're talking telcos with Gaston Amoros, a Senior Analyst on our Australian Fund. Hey Gaston.
Hi Steve.
Now for your sins, you've been covering the telco sector here in Australia for quite some time. It's gone from a growthy, sexy sector back in the 2000s to something that is quite boring now, and you don't see a lot of it on the front pages of the paper. What's the general backdrop here and why has it become so boring?
Well, the sector has consolidated quite a lot in the last decade or so. We're basically left with three large guys, Telstra, TPG and Optus. Given that Vocus just got taken private, we have a few smaller players like Unity Wireless, also Broadband and MNF, but it's highly consolidated. It's a mature sector. There isn't much growth or innovation that you can monetize. It is hard to disrupt given the big network effects, but it does generate high cash flow that companies typically pay out as dividends. So yes, as you said, it is perceived as mature, boring but stable dividend-paying sector that people typically own for income.
Now, we don't own Telstra, but I know a lot of people out there do. Maybe just give your 30-second thought on Telstra as an investment at the moment.
I think it was very interesting 12 months ago when the shares were at $2.80 or $3. Since then, two things happened. The company reassured investors that the dividend of 16 cents is safe. And then the company moved to provide more, to highlight the value of its infrastructure, be it through a potential spin out of the InfraCo or by selling 50% of its tower assets at a very good price, and everyone got excited. And as a result, the shares are 40% higher, and you still get a decent yield of 4%, but it's not the good opportunity that it was 12 months ago.
Yeah, I think in this interest rate environment, a 4% yield is certainly not crazy, and with a lot of other asset prices out there, but it's not the one that we own in the portfolio, but we do own TPG. Now, this was a really popular founder-led business. David Teo built this up and created a huge amount of shareholder value. He's merged it now with Vodafone. He's headed for the exits. It seems to be a much less exciting story. What is the investment case here?
It's very simple. It is cheap free cash flow. We're talking about 8% free cash flow yield, so that is definitely cheap. The mobile business, they have two businesses, mobile and fixed. The mobile business is getting better, but the prices are drifting higher, and that clearly helps margins given the high fixed cost nature of the business. On the fixed side, margins have been compressed by going from reselling ADSL to reselling NBN, and from here on, whether the NBN cuts prices or the networks themselves bypass the NBN by selling 5G wireless, either way they win by making more margin as a reseller. And finally, debt is coming down, and as debt comes down, they'll start to pay a dividend in line with that free cash flow generation that I talked at the very beginning. So in a nutshell, that is the case. The fact that David Teo stepped down as a chairman doesn't help sentiment clearly, but it doesn't affect the way the business is run.
Yeah, not anymore. I think this is a business now that needs to focus on cash generation and paying it out. And we do view it as much more of an infrastructure type stock, and that 8% yield being particularly attractive in the current environment. There is one little piece of optionality here. I've just moved houses recently and we are not connected to the NBN at our new house. We've signed up with Telstra's mobile 5G plan, so a little box in our house that's a mobile connection to the internet, but on the 5G network, the speeds have been amazing. We haven't had any trouble with the connections at all. It's actually been a fantastic home internet service. And this opportunity for the existing mobile players to cherry pick NBN customers seems like something that could be interesting to me.
Correct, Steve. The likes of Optus and TPG are cherry-picking high-density customers with their 5G offering. The way it works is you roll out a bit of infrastructure and you get a customer at the same price at which you were reselling the NBN, but it's on your own network, so you don't have to pay away 80% of that to the NBN. It's all profit for you. So it's pretty attractive. Although, to be clear, we're not arguing an investment here in TPG purely because of that, because the take-up is obviously not going to be 100% across their fixed base. But a small decent take-up is a meaningful upgrade to earnings expectations. So it's another driver of our thesis here.
Yeah, and the big customer acquisition expenses there have already been spent in terms of acquiring those customers. So hopefully in some modest cross-sell could add to the cash flow, but it's the core cash flow from their existing infrastructure that we're most interested in here. I think there's a really good case in a portfolio in today's market for some of these larger, boring, stable businesses that are going to pay you cash flows. There's a huge amount of excitement and optimism about some of the smaller growing stocks, but I think this part of your portfolio is really important, and this TPG can be one of a few of these types of businesses that we've got in the Forager Australian Shares Fund at the moment. Don't forget our roadshow is coming up in the next couple of weeks. Jump on the website and register for it. Gaston will be there with me, and any questions that you've got for him, make sure you scribble them down now and bring them along. Thanks for tuning in.